We're at MIPIM 2026, and we are joined by Mr. Mathew Crowther, who is Senior Portfolio Manager of the Precap Series at PGIM Real Estate. Mathew Crowther, thank you for being with us.
Thanks for having me here.
I am also joined by my colleague Chante from the CoStar News team. Thank you very much for being with us also.
Thank you for having me.
Maybe to start the discussion, Mathew, how has the market environment supporting real estate debt strategies in Europe evolved, given that the macroeconomic context until recently appeared to be stabilized, but given the recent turmoil, might not be anymore?
Yeah, look, maybe if we go back to 2022, 2023, when the market was really suffering a lack of confidence because of high inflation. And look, at its simplest level, real estate is just so influenced by interest rates, right? So when there was higher interest rates and inflation, it was very difficult to price. People were concerned about values and the market did lose confidence. And we saw that ultimately, about a 25, 30% reduction in value, probably from its peak to trough in European real estate values. So we've worked through that aspect of it, and I think the market was seeing an easing in inflation and easing in interest rates, which is therefore being more permissive for debt and supporting more transactions in the market. Until recently, okay, we are looking forward and thinking, okay, well, is there going to be concerns about global energy prices and inflation going forward? But let's be open. We've already corrected 25, 30%, and we've seen some easing in interest rates, and we hope that at least remains stable for some times, and that was what was helping the debt market. I think the other thing too is put values to one side. When interest rates are higher, it costs more to service the loan, right? There's only so much rental income from a property. So actually, one of the biggest things in 2022, 23 was actually higher interest rates meant you just couldn't get as much debt on an asset because you couldn't service the loan as much. There was only so much rental income coming from the property. So I think the easing of interest rates in Europe, back to around the 2% level. We've seen some easing in the UK. We would have hoped that would progress a bit more, but certainly those calming of interest rates and the more certainty around valuation was what created that confidence in the lending space. And we hope what has happened the last few days, doesn't impact too much that sort of easier run we were hoping for in this space.
Already, specialists in financing and debt markets, including yourself, are saying that 2026 is a particularly attractive moment in the debt cycle. With that in mind, what has shifted most materially, do you think, over the last 6 months to unlock deal flow?
Yeah. But I think let's just look at real estate fundamentals to start with. So as I said, our view would be real estate values generally in Europe are probably about 20% below trend. So I talked about that 25, 30% market correction. So in terms of global asset class, right, real estate looks really quite, fairly valued. We've had that sort of fundamental shift and it looks well valued. I think the other huge opportunity for Europe is the lack of supply. So in our view, over the next, say, 3 to 4 years, we expect supply of new real estate in Europe to be at its lowest level in almost 40 years, right? This market shock has meant that we've got, not enough capital's gone into building real estate. So to the extent we can support that through our debt program, we know we're building brand new stock, good quality, it's where the tenants want to be, and it should be very liquid and financeable or sellable in the market. So I think that has been where our focus has been. And then I think also fundamentally we're in an income world now, right? So if interest rates aren't going to fall much from where they currently are, we've got to acknowledge that actually real estate values aren't going to be, it's not going to be cap rate compression, it's going to be interest rates falling, they're going to drive valuation, it's going to be income growth, focusing on real estate and the fundamental rental income and supporting that, which is great for a debt strategy because more income means we get our interest paid, right? If that makes sense.
And on that theme of kind of debt versus equity, looking at today's market, has the gap between what equity underwrites and what debt will support widened or eased?
Yeah, look, I'm in a really fortunate position to observe this. So I'm part of a lending team that sits beside a real estate business, right? So I've got my real estate colleagues on one side, I'm on the lending team on the other side. And I would say, look at over the last 12, 24 months, there has been a narrowing of that gap. And I think part of that was the easing in interest rates, right? How much debt you could get on an asset depended on how much rental income there was. As interest rates have fallen, it just made that interest cover metric work better and be more supportive. So I think, the easing in real estate values, the easing in interest rates has really helped narrow that gap. And I would say, actually, the debt markets were recovering faster than the equity markets. There was more capital in terms of private credit flows, debt capital flows coming first. So we're actually seeing more liquidity in that sector. What we would like to see now is more capital coming into the equity space, and particularly core real estate space, right, which would fundamentally help the market along. Yeah.
Thank you. And maybe before I let you go, I have to ask about your strategy at PGIM Real Estate specifically. How are you adjusting the strategy in Europe to capture this new phase in the cycle, this easing environment that you were mentioning earlier, where unpredictability seems to have become the norm? How do you adjust?
No, you're absolutely right. So if you look over the last few years, we've dealt with, COVID, Brexit, Ukraine, what we're going through at the moment. So we fundamentally focus. Today, when I lend, I don't know what the market environment will be like in 3 to 5 years when my loan needs to be repaid. So our focus is very much where is the quality real estate, and how can our borrower grow the value and the quality of the asset over time? And I talked about that fundamental lack of supply in Europe at the moment. So as I said, the lowest supply of real estate in 40 years expected over the next 3 to 4 years. So if we can help partners, build and develop and stabilize assets in those classes, we hope that they will be some of the most liquid, where the tenants want to be, where the real estate income is going to grow, so that even if I come out into a volatile market in 3 to 5 years, it should be some of the best real estate and should be able to either refinance or sell to maintain my exit. So that's been our focus.
Thank you, Matthew. Thank you, Shante. Thank you all also for being with us, and we'll see you soon on BITV.